And all this violence is racking up huge bills. The war in Ukraine will cost the world economy $3 trillion by 2025. This is the estimate by the Center for Economics and Business Research. The war has disrupted supply chains. It's led to inflation. It's put energy markets under pressure, and all of this is going to cost the world dearly. The war began in February this year. It's been less than a month. So far, the global economy has lost $1.7 trillion. The paper says the economic impact of the war will be felt through 4 channels: lower consumer confidence, higher inflation, tighter monetary policy, and disruption to global supply chains. Take these one by one. First, lower consumer confidence. People are generally feeling a lot more pessimistic about the economy. In the US, consumer confidence is at a 10-year low. Europe, it's at a 15-year low, and this is understandable. You have inflation at multi-decade highs, the threat of a recession, and now a war in Europe. All of this is taking a toll on consumers. So they're pulling back on spending. The result is this: lower economic growth. The paper says global growth will be $1.3 trillion lower in 2025 than previously expected. America will suffer the most. Its GDP will contract by $1.5 trillion. Europe will lose $1.1 trillion, and the UK will lose $0.8 trillion. What about India? The paper does not mention India specifically, but India will definitely feel the impact. There are some estimates, though. India's GDP growth is expected to fall from 8.4% to 6.8%.
Oh.
Let's talk about inflation. It's already at a 30-year high, and it will stay that way. The war has put upward pressure on food and fuel prices. Now, these are essential goods, so when their prices rise, so do the prices of other goods. The result is this: a wage price spiral. Workers demand higher wages. Employers pass on these costs to consumers, and this keeps inflation elevated. How long will this last? Until 2025, according to this report, global inflation will remain 1.5% higher than pre-war levels. Which brings us to the third point: tighter monetary policy. To bring down inflation, central banks will have to hike interest rates. The US Fed has already done that. It has hiked rates by 75 basis points, the biggest single increase since 1994. Other central banks will follow suit. For example, the European Central Bank. It will have to strike a delicate balance here. On the one hand, it must tame inflation. On the other, it cannot derail the post-pandemic recovery. Finally, let's talk about supply chains. The war has disrupted them. There are shortages of key commodities like oil, gas, and wheat. There are also labor shortages because many Ukrainian workers have had to flee the country. All of this is leading to production cuts. Car makers, for example, are cutting down output. There are also delays at ports. For instance, many container ships are stuck at the Romanian port of Constanta. They're waiting to be unloaded or loaded, but the port is short of workers, so the wait is longer than usual. Longer. Such disruptions will keep supply chains under pressure, and that means inflation will remain sticky. So what can governments do to cushion the impact? The paper mentions 2 things: public investments and tax cuts. Governments can spend on infrastructure and offer tax breaks to businesses. This will create jobs and boost economic activity. But governments themselves will have to borrow more to finance these projects, and that could lead to higher interest rates. The world economy was already on the edge. This war has pushed it to the brink.